Hey friends, Lucian here with the Bullish Bears team. This video is going to be about credit spreads. So the credit spread strategy is one in which you sell an option at one price and then you buy another option with the same expiration date. And when you do this combination of selling an option and then buying an option, it creates a net credit called a premium. So when you're doing this strategy, if price closes above or below your short strike, and your short strike is the one that you sell, so credit spreads are a selling strategy. So the short strike is the strike that you sell first. If price closes above or below, depending on whether you're doing a bullish or bearish strategy, before expiration or at expiration, then you get to keep the full premium. So at expiration date, if price is above or below that short strike, you get to collect that full premium. So let's take a look at an example here. We'll use Facebook as the example. I took a screenshot of what it looks like to do a credit spread. So you're doing a combination of selling and buying an options contract. So if you look at the bottom left, you'll see the primary at the top under next to vertical, you'll see sell -1. That's your primary or your short strike. So this right here is a call credit spread. So if you do a put credit spread, you would just choose the short strike that you're looking to implement with a put credit spread. So call credit spread is a bearish strategy, and a put credit spread is a bullish strategy. We explain more on how to implement both those strategies in our options courses. So if you want to see how to place a trade with both a call credit spread and put credit spread, make sure you take our options course. So again, take a look at this picture. You'll see it's just a combination of buying and selling, but selling being the primary. So I'll say it's a combination of selling and then buying another. And by doing that, if you look at the order dialog box, it lowers your max loss. So again, with selling strategies, actually take another step back. We'll go with buying strategies first. When you're buying naked calls and puts, the most you can lose on that contract is what you paid for it. So as an options buyer, the most you can lose on a naked option is what you paid for it. Not the same way with selling an option. If you sell a call or sell a put, the losses can be infinite or astronomical. That's why we're not big proponents of telling people to just sell naked options. If you're going to sell them, put them into something like a credit spread so you can lower your risk. So you'll see the max loss on this compared to just selling naked is very low. So something to be aware of is the buying power effect. That's margin. So, if you have a bigger account, 25,000 or more, then margin's not really as much of a big deal. But when you have a smaller account, margin, it takes more margin requirements to enter into a trade. So even though the cost of the trade, you'll see on this order box, it says $142. And then at the bottom it says 145. Don't get tripped up on the differences because I took the screenshot and obviously that was during live market hours, so the price changed a little bit. But the margin requirements are going to be more to enter into the trade than the actual cost of the trade, because again, if you lose or you get a max loss, your broker has to have the money to cover it. So they're kind of like lending, or with margin, they're giving you the ability, they're kind of holding those funds available. So just in case if the trade goes against you, so if it goes over the cost that you got to enter into the trade, they'll have to pull from the margin amount. So that's where that buying power effect is. So on a smaller account, one of the limitations with margin is your broker will hold a little bit more, or hold more than the cost of the trade, just in case the trade goes against you. So again, don't get too caught up in that right now, but just look at it's the combination of selling and buying an options contract. It lowers your max loss. And again, that's the order dialog box. Each broker gives you a summary of when you enter into a trade, and you'll see those things like break-even prices, max profit, max loss, and that buying power effect or margin that's required to enter into each trade. So what you'll find if you're new to the world of options is it gets a little bit confusing because there are several names for the same strategy, especially when it comes to spreads. So the two most popular names are, there's two for each category of credit spreads, but then it can even go a little bit further. So let's just talk about the most popular ones for both bullish and bearish strategies. So if you're bearish on a stock, you'll hear the terms call credit spread and then also bear call. That is the same thing. So when you hear the terminology call credit spread or bear call, same exact thing. Why people call it something different, whatever. It's just terminology comes throughout the industry, and then people will call the same thing multiple different names. You may also hear things such as like long vertical or short vertical. So again, there's even 3 and 4 names, but the most popular names for a credit spread, if you're bearish on it, it's called call credit spread or bear call. And then when you look at a bullish side of the fence, that's where you look at put credit spread or bull put. Again, same exact thing. You might hear long vertical as well. So you might hear long vertical, short vertical. So again, just don't get tripped up on the names. Understand what you're looking to do. Don't get too caught up in the names. It's good to take a screenshot of this so you kind of keep it, file it for your memory. So when you hear these terms along the road, you don't get too caught, you don't get so confused. That's one of the biggest things that trips a lot of people up, is trying to understand that the multiple different terminologies are the same exact thing. So again, when you're bearish on a credit spread, you're doing a call credit spread or a bear call. And when you're bullish or entering into a bullish spread, you're either doing a put credit spread or a bull put. Now I want to talk to you about something called probability of out of the money, or OTM. So you'll see the term OTM, which just means out of the money. So you can add a column to your options chain in some brokers, which is called probability OTM. You got to check with your broker just to see what they call it. And what this column does is it shows you the probability of success on your trade. Right? So what you'll do is when you enter into the trade, specifically here in this video, it's going to be on credit spreads. You want to look at the column next to your short strike, and then you'll be able to see your probability of success. So I'm going to show you an example in a second, but it's very important to take profits, along the way. So if you see the probability of success, if you take your take your profits along the way, let's say around 50%, then you increase your probabilities of success. So let's take a look at an example here. This is the Thinkorswim platform. You'll see I have the column added up there of probability OTM, or out of the money. So remember, with credit spreads, you want the contract to expire out of the money because you're an options seller. When you're an options buyer, you want the probability to be in the money. So you want your contract to expire in the money as an options buyer, and then as an options seller, you want it to be out of the money. So you can change the column to in the money if you're an options buyer, or you could just flip it. If you had OTM here, you can just look at the other side would be in the money. So again, whatever column you're looking at, just look at the other percentage for the opposite. So when you see this column here out of the money, if you look at that credit spread, if I'm selling the 285 and I'm buying the 290, my short strike is the 285 price, which basically means I have a 68% or almost 69% chance that by expiration, price will be below that 285 strike price. That's if I fully let that contract go until expiration. So that's where, again, almost a 69% chance of a win. However, along the way, if you take profits, let's say around 50%, you increase your probabilities of success. So this is to full term expiration. If you take profits early, obviously your probabilities of success will go higher. But something really important to remember is just because you have a high probability of success, you have to be able to know technical analysis, when to enter into a trade, because if you just jump into a trade randomly just because it has a high probability of success, you could be down on that trade for a long period of time, or most of the options, if you get in, you could be down most of the time period. That's why you have to get good entries, know support and resistance levels, so you have that option go your way more right off the bat, rather than going through the pain of being down on that spread just because you're entering into a trade with a high probability of success. So just because this will show you a higher probability of success and you can build your trades based upon that, don't do that just because it has a high probability of success. You have to understand, candlesticks, support, and resistance, and when to enter into a trade. And those are things that we teach you in our community and in our trade rooms on a daily basis. Now let's talk about some of the positives and negatives of credit spreads. So a positive is that it lowers your break even and it caps your losses, especially with those selling strategies. If you're selling naked calls and puts, again, I can't stress it enough how risky that is and how much money you could lose if you're not careful. So doing a selling strategy that moves into a credit spread, again, caps your losses and helps you to minimize your risk. It also requires less capital to enter into a trade. So when you're selling naked, again, way more capital. So when you're putting it into a spread, again, less capital to enter into the trade. And you don't need to be very directionally biased. You still want to get the direction right overall, because it gets that option to move in your direction a lot quicker and be in profit a lot quicker. But even, if you get it away from your strike price could just trade sideways and you can still make money on your spread. So you don't have to be very directionally biased. Something, that's a negative is there are caps. Your gains are capped. So, there's not unlimited amount that you can make. So again, like with anything, don't get too greedy, right? It's nice to want to make unlimited profits, but that's also not realistic. So a negative is it does limit your gains. And then margin, it does tie up quite a bit of margin in your account, depending on your size account. If you have a smaller account, there's less credit spreads that you can implement at one time. If you have a bigger account, there's more that you can do. Now, if you want to make more money on a credit spread, you can do one of two things. Either one, increase the amount of contracts that you buy, or two, you can change the width of the strikes. So in my previous example, you'll see I did a credit spread that had a 5 width strike. So I sold vertical. I had a 285 and 290 right here. Now, obviously, I'm making the video live now compared to when I was taking a screenshot, so the credit's a little bit different at the moment. But you'll see I would take in about a $150 credit. Now, this is with a 5 strike difference. If I wanted to receive more of a credit, I could go, let's say, to a 10 strike. Right? So you'll see the credit comes in, and instead of 150, now it's 250. But when you do this, just realize your risk also goes up as well. So you want to be careful, just like with anything, you want to let your winners run, take your profits along the way, don't get too greedy, but also with your losses, don't go for those max losses. If the trade goes against you, keep those losses small. So again, don't let yourself just get to these max loss levels. But you'll see, with a 10 risk or 10 width, you'll see the risk is 742. When you go to a 5 risk right here, or 5 strike width, you'll see the risk was $350. And I'll show you the difference here if you did a 2.5 strike, right? So if I went from the 285 to the 287.50, you'll see the credit is $82 and then the risk is $168. So basically, if you want to receive more credit, instead of just changing the amount of contracts, you can widen the strikes, receive more credit. Just realize that your max losses go up as well. But just like any type of trading strategy, take profits along the way. Don't get greedy, and then with your losses, if the losses go against you, make sure that you keep your losses small.